Hello and welcome back to The Note. Well, we've ended the week on Wall Street with a classic payrolls Friday. Let me take you through what occurred. Now, we've got the most important number here, or the one that's most closely watched, the monthly change in payrolls. It was dramatically better than expected following September's number, which was dramatically worse than expected. The bottom line, I think, is that first of all, those numbers are in line with the long-term trend, and that long-term trend is of very steady growth in employment. We all know there are problems, weaknesses with the labour market, but that underlying growth continues to be a fact. This is ultimately a poll, it's a survey. Polls are subject to occasional outliers. It looks like September's was an outlier. Now, beyond employment, everybody is looking at this through the lens of what the Fed will do next month. It has to be concerned about full employment. It also has to be concerned about inflation. And the critical number on inflation from this report is on average earnings, which we can show you here. And very importantly, we can see average earnings at last very distinctly starting to pick up. This is in line with what some of the companies have been saying, reporting on the third quarter. At last, there is some kind of growth which is actually filtering through to people on Main Street. You could argue that this is the perfect chart to demonstrate why so many people in this country feel they have been left out by the economic expansion. It now appears to be spreading into average earnings, which is great news, except that it increases the chance that the Fed feels it needs to raise rates to head off inflation. Now, let's have a look at how the market reacted to this. The two-year Treasury yield shot up, as you can see there. That was to its highest level since early 2010, at a point when people assumed that there would only ever be one QE program from the Fed, certainly not QE2 or QE3. But you can also see that after that immediate shocked reaction, it did come back quite a bit. Plainly, this it strongly increases the chances of a rate rise in December, but there are still some reasons to think that that might not happen, which I'll come to later. If we take a look at the Fed funds futures market, we now have a substantially 70% chance or more of a rate rise next month. What is intriguing is that we now have more than a 60% chance that there will have been a second rate rise by June of next year. A lot of the research today has moved on from assuming that there will be a rate rise next month to ask whether the Fed might actually move a little swifter than people are expecting, that this won't just be a one and done. Plainly, the conversation in Wall Street has changed very swiftly, given that only a few weeks ago it was assumed that we weren't going to get a rate rise next month at all. Now, what could stop the Fed from raising? We've obviously discussed the Fed's reaction function. There was some confusion about that at one point, but it seems from the statement from the October meeting that they are very clear that the unemployment picture as it stands at the moment permits them to hike, and that they want to hike. Inflation, as we can see, perhaps now does give them some reason to move. The other critical reason, however, why they may not move concerns the international environment. If we take a look at emerging market foreign exchange as measured by JP Morgan, you can see that as of September, when the Fed decided not to go through with a rate rise, there was acute pressure on emerging market currencies. Now, the Fed doesn't need to be making policy for the sake of emerging markets, but it does need to consider the risk that a run on emerging market currencies could convert into a true crisis which affects financial stability across the system. You can see that emerging market foreign exchange recovered quite a bit as people thought that the Fed wasn't going to raise. It is now weakening again. I suspect that if you saw this line here actually drop to a fresh low, if you saw fresh concerns about crisis in emerging markets, if you saw a very dramatic reaction in bond markets, more dramatic than we've seen so far, that might still keep the Fed from raising. But it appears that it really is only that is going to stop them. Both unemployment and inflation data at this moment, along with the Fed's clearly stated intention, suggest that we do have a rate rise to look forward to next month.